the name of the game in real estate is leverage. And the lower your LTV gets, the less leverage you have, right? And the less attractive the deal starts to look.
So we're trying to figure out we have a few different options for the next property that's coming down the pipeline, the one that's in Arizona.
Yeah, Phoenix, Arizona,
in terms of how to structure it with respect to the timeline and the rate.
Yeah.
Walk me through the different options and even why we're questioning this in the first place.
Okay, so the best option that we came up with, the best option that we were quoted with was a Fannie Mae product. And for those that don't know Fannie Mae, there's Fannie Mae and Freddie Mac over there. It's an acronym, but it's the federal agency bank lending, institutions over there. And Fannie Mae typically likes small balance, which typically is, maybe $7 to $8 million and below. Freddie Mac typically likes higher balance. You can get a Freddie Mac small balance, but they make it non-competitive so that it pushes you into a different type of lender. So this particular property with a $5.4 million price tag is more of a Fannie Mae product. Fannie Mae also typically has a less attractive LTV because of its smaller balance. Okay, so once you start getting up in a property size, they typically allow you to have a stronger LTV. Now, I'm trying to figure out what term is most attractive right now. We have options. Fannie Mae offers anywhere from a 5 to 10-year term currently. They don't offer anything 3-year, but what they do is they offer a 5-year with a 1% buyout, which means you'd have to pay a 1% penalty fee on the remaining loan in year 4 and 5, which is actually not bad. So it'd be a 3 plus 1. So it wouldn't be like they don't even offer a step down. But the problem with that though is they would require, in order to get that kind of product, they would add points to the rate. So right now on a 3-year, let me just actually even pull it up. On a 5-year term, right now, the LTV is lower. So we're shooting right now. Actually, I'll start with the 10-year. Right now, the 10-year term, we're looking at a 5.42% rate at a 65% loan to value. And then he quoted me at a 7-year term at 5.51%. And the LTV would be 63.1, call it 63.14.
Okay.
And then a 5-year term would be 5.8% at 61.3% LTV.
Is that a straight 5-year or is that 3 plus 1 plus 1?
That would be straight 5-year.
Yeah.
That's not including the plus 1. Okay, we can add that too. So a 3-year, they don't do 3-year deals, but a 5-year deal with flexible prepay. So flexible prepay means like you could get out of it.
Yeah.
After 3 years, there would be an adder. They call it an adder for that. Likely 20 to 30 basis points to the spread.
Okay, so from 5.8, it would go up to like 5.82 or 5.83 or something like that. From 5.8 to 20 basis points.
20, yeah.
Okay,
call it like 20 to 30. So add like what is that?
It was It was at 5.8, so it's probably like 6.6 to 6.
5.84. So it'd be like 610.
Yeah.
So do like underneath that like a 3 plus 1 plus 1.
Yeah.
Do like like a 610, 6.1.
Yeah. And LTV on that one?
It would be the same as a 5-year.
Okay.
Yeah. Which might be that one, to be honest with you. So that's what we're looking at.
Now, for anyone listening, explain to people why this is in the later stages of due diligence. This is probably what you and I talk about the most.
About what rate?
Yeah.
Yeah.
Explain to people
the financing, yeah.
Around the financing.
Yeah.
Explain to people why this is so important.
So, according to these numbers, so we've got, let me just rifle these off. Okay, so according to these numbers, Connor, pop these on the screen too so people can understand. So we've got a 10-year term, 5.42% with a 65% LTV. Down from that, we've got a 7-year, 5.51% with a 63.1% LTV.
Mm-hmm.
After that, we've got a 5-year at 5.84% rate, 61.3% LTV. And then another kind of, hypothetical scenario, we've got a 3+1+1. It's essentially a 5-year rate, but they give you an option to buy out of it after year 3 at a 6.1% rate and a 61.3% LTV. Now, you'd have to reduce the buyout because you'd be paying out, like, for example, an extra $30,000 to the bank, right? So that would come off the capital gain, right? The reason why this is so important is because people might be asking, well, why does the LTV drop? The LTV drops because the affordability, based on the increasing rate as you come down off the 10-year, gets higher, which affects the affordability. And when you affect affordability, you affect its ability to cover the debt, which is why the coverage ratio, when you have a specific coverage ratio that these lenders want to see, which is, I believe on this one, a 1.2% or a 1.2 time coverage ratio, when the rate goes up, it affects its ability to service the debt, which is why the LTV drops and you're requiring more capital to put down. So what we're trying to figure out right now is at the 10-year...
Well, even before that, now walk through like the pros and cons of like why is a lower LTV worse, for example?
Well, so a lower LTV, you always want to maximize your capital, right? The name of the game in real estate is leverage. And the lower your LTV gets, the less leverage you have, right? And the less attractive the deal starts to look, right? Ideally, what I like to do is I like to go in 75, even 80, but those days are done. It's the affordability is really restricting, or the rates are really restricting the ability for properties to cash flow enough to cover the debt enough where the coverage ratio will be able to support a higher LTV in the 70s or 80s. The 80s are, forget it. Yeah. They're done. So ideally right now, I'd love to get a 7 on the deal. 7s are very hard to come by. You need a really strong cash flowing property. And to be honest with you, the problem is when you have when you're able to get an LTV with a 7 on it, like in the 70s, and it's got very strong cash flow, the cap rate is typically very high. The problem with those properties is they're in less desirable locations. There's like nuances with the property where, a lot of the financials might be on like a napkin kind of scenario, back of a napkin kind of situation, not really proven, just a less desirable, less quality style of product. And less desirable submarkets, things like that, but they're strong. It's just not something that I want to get into, right? I want strong property that I know it's going to cash flow, and the cash flow is going to be decently strong, somewhere in between 5 to 7%, but we're going to have very strong appreciation on that property because of submarket fundamentals. And that's where people make the most money. It's not on the cash flow. However, a property's ability to cash flow is ultra important still. So the strategy behind the 10-year is that's the most attractive rate right now and the highest leverage. Okay, it's got a 65% LTV. I happen to like that the most. The reason why I like that the most is because I don't think rates will come down much less than that. I do think they will come down, but I don't think we're going to see, 2%, 3%. I think we might land in maybe the mid to high 5s at some point, but at that point you're not far off from this 10-year rate, okay? And maybe in the next 10 years it might even fluctuate a little bit between those. Might even go up, who knows, right? Who the fuck knows? It might actually even increase from that point. So if we're in a long term where, I've always said the most attractive I feel for where rates need to be is right around a 5%, maybe even high 4s. So if we're not far off, where we're only 42 basis points off of where I think the target should be, it's not a bad rate, I don't think. I really don't think it's a bad rate. This is actually probably if you were to look up the average interest rate over time, it's probably around that. So I don't think that's a bad rate. The problem starts to come in where if what I think is going to happen in the next year, 2 years or whatever, where we're going to see rates maybe in the high 3s, maybe low 4s, it really starts to change the deal, okay? So at that point, would it make more sense to be in a 3+1+1 at a 6.1, where after 3 years we can get out of the deal, and even if we want to strategize with the current investors on that property, where hey, let's stay in, refi for an extra 10 years at maybe like a 3.5 if that's where rates are going to land, or maybe even a 4, so that we can shave off 1%, maybe 1.25%. That might be a very attractive play, but it's completely speculative. Whereas a rate around a 5, to mid 5s, it's still attractive. It's still an attractive rate. And it's way more attractive than what you can get here commercially. So that's, and the leverage is high. That's why I like it. That's why I like the 10-year. But you're saying a lot of these investors potentially might be short-sighted and want to see,
specifically because the lack of proof of concept
of us.
Yeah. And it's not to say anything with my confidence of the deal, right? It's just a factor of if I like this weekend. This weekend I'll ask them again of like buddies who like likely will come in on the next deal. Yeah. It's probably about 4 or 5 of them. That what they think about these different things, because they have a interesting vantage point, because they essentially just started making good money. They started having some cash flow. They're also sitting on cash because they're not investing it anywhere else, because everything else is doing shit right now. And so I'd love to compare that to, I might also ask a few of like family members that are in their 50s, 60s, 70s that also might be looking to invest in this type of thing, and what they would, I think the answer would be different.
What I'll do is I'll leave it over this weekend. I'll build this model out. Yeah. For all three, the fucking problem is I'll build it out according to what a 5-year would be, based on the rate. We're gonna build all of our models based on a 5-year term. Yeah, I think based off of a 5-year term,
because it compares apples to apples.
Exactly. Yeah. So I'll build it out for what I think is gonna look like, and then we'll go from there.
One of the things that you said in this podcast here that I think really stood out to me was you mentioned how the most money that you make in real estate is on the sale of the property, not from the cash flow necessarily.
Yeah.
With that being said, a shorter turnaround of where you're able to get to the investors to that point sooner, I think is stronger, right? Because they're going to be looking for, if you could say, hey, we have a 1-year term on something that will just turn around super quick, and
that's dangerous.
It's dangerous. Yeah. And I think that
I would never go into a situation like that unless I had an option to renew.
Right.
Or refi or something. That's way too fucked up. The reason why I'm getting this property right now for arguably a deal is because they don't have an option.
Yeah.
Or they could refi, but they don't want to refi.
Right.
They already know what the fuck is coming down the pipe. They can't afford it. So they can't afford it. What the fuck was the reason why they can't even afford it? I can't remember. They have another project on the go. They're kind of flippers. They'll go in. This property, again, you know this. It's been completely renovated, hardcore renovated. So they want to move on to the next property. They're not a buy and hold group. They are a turn and burn, good quality, buy good in good locations, buy Class A assets, and so they're actually office building converters. So this building was essentially a Class A office building before, and they what do you call it? They condensed the unit density, if you will. Yeah. So there was, arguably like a 50.
Interesting business model.
It is actually, yeah.
With the demand for office space decreasing,
it is,
but the need for residential housing on fucking all-time high.
Yeah, and what's really interesting is when you do that, the people that are buying the conversion are getting a really good deal because it's basically a new building. Yeah. Like this thing it was ripped right down to the studs. And in order to do what they're doing, and office buildings are typically built better quality, which is odd. This particular place, concrete flooring.
Yeah.
It's only a 2-story. You wouldn't see that typically. You would see that in Florida because of hurricane structures, but you wouldn't see this in Arizona. It's got concrete flooring, and the concrete flooring was like dyed. It was polished. So you don't have a situation where you're going into this building and someone's fucking the floor up and you got to change it out. No, it's concrete, but it looks great. Like I would put concrete in my house.
Yeah.
Like it actually looks really nice. So this place has a lot of positives. In suite. laundry, which is very rare. 2-bedroom, the majority of the units. 3 parking spots per unit, which is huge, especially if you have a 2-bed. So you have, you know, if you have a spouse, you got, you know, 2 spots for the people that live there and potentially a guest, which is huge. Yeah. So a lot of advantages here, and you know, 12 minutes from the airport. It's near where the new Coyote Stadium is going up.
Oh, cool.
Yeah, so there's a lot of drivers. There's a lot of fundamentals in this market here that I like.
So,
but anyways,
not looking necessarily at
kind of went on a tangent there.
That's all right. It's all good stuff.
Yeah.
It's not necessarily like obviously putting it into the deal sheet one more time this weekend is going to be very important.
I haven't built it out with all of these scenarios.
Right. But even just conceptually speaking, what are you leaning towards? If it was just you by yourself, you'd go 10-year all day long, right?
Yeah. I would, but the more I think of it, probably the 3 or the 5.
Like removing all optics from investors, like just you. You're
just me. I go 10.
Okay.
Yeah. Because now here's a catch. The reason why I'd go 10 is because you make the most money in real estate long term. So if you make the most money waiting for the property to appreciate, well, you're going to make the most. It's just a compounding factor now at that point, right? After 10 years in this high growth market, you're going to get fucking. You're going to triple, arguably, the cost of the property.
So then maybe there's your answer.
Like I would do that. That would be my goal.
Ultimately, at the end of the day, people are investing along with your expertise.
Yeah.
Right.
The problem here's a differentiating factor. If the 10-year rate was in the 6-7% range, well, that would change things, right? But it's not.
Right. 5.4.
Yeah. 5.4. Right? Currently. That's not crazy bad. Even if we wanted to, and here's the thing too. If the market shifts, we can still sell the property. Somebody would just have to assume the loan.
Right.
It's not the end of the world. Get what I mean? That's it. It's not a big deal. So you got to think, if the property appreciates, say in 5 years we want to get the fuck out of the property, okay? And the rate is 5.4%. It's an interest only rate. Now, what's attractive right now is interest only. And the reason why banks are doing interest only is because they know, owners of properties, they need the cash flow. They're not going to buy something that's not going to cash flow. So what are the lenders doing? The rates are high because they can't do anything about the rate. But what they're doing is offering different products, interest only. So an interest only loan, it's still attractive even if the rate's high. Okay, consider it like a bridge or something like that. So consider this: in 5 years, the rent goes up 50%. Okay, the property is now worth $10 million. You don't think we're going to be able to sell that? Of course. So okay, even consider this. Because of the shittier loan, right? In 5 years, and the fuck am I trying to say here? The less attractive assumable mortgage that we have to do in terms of moving the property, right? We have to someone has to assume the mortgage. It's less than desirable. So consider this: because of the less attractive rate at the 5 year mark for somebody to assume, say we take a $500,000 haircut, but the market's moved considerably, so the property's doubled in value. Doesn't that still make sense for somebody to buy? I would still buy it. Like there's options to move property even inside of a 10-year.
Yeah.
So I really don't think it's that big of a deal.
Related, but I think this can be still in this same clip, but also clipped out separately.
Hold on a minute. Here's another thing. Talk about the clip.
Because this is quick. How do assumable mortgages work? Because that's something that I feel like, especially in this market in particular, is like I've heard people ask about this.
Assumable mortgages?
Yeah.
Okay. So an assumable, Clark's asking, how does assumable mortgage work? How does an assumable mortgage work? Basically, it's a mortgage that you assume that someone else originally got. And that is it.
Is there any limitations to it?
No, you just have to qualify the same way that the original buyer did. And that's it.
Any penalties or anything for the seller?
No. They would have to, there's probably underwriting costs and stuff like that involved, but typically you're probably even less expensive than to originate the loan rather than assuming the loan. So it's actually probably, there's probably a silver lining there. Now, here's another thing too. The reason why the 10-year is so attractive to me, even with a buyout structure halfway through, what happens if the rates actually don't decrease all that much? So now you're still in a good spot, right? And then if the rates decrease, what happens is banks are less likely to offer interest only, okay? Right? So there's that. Second, if the rates do hover around where they are or increase, now you're in even a better spot, okay? And then consider this. For the first, I don't have the amortization schedule in front of me, but at what point in the first 10 years are you even really paying in principal, paying down principal? It's really not that much. So arguably, moving forward, if we're structuring these deals anywhere from 10 years and below, I'd argue that our goal should really only be interest only and really stress the cash flow as high as possible, or push the cash flow as high as possible. There's really there's arguably no reason for us to want to have to pay down the debt unless the rate is very low. If the rate is very low, then that's different. But even when, here, I'll give you an example. Here's the fucking thing. Even when the rates were stupid low, when I did Canton, Michigan, when the rates were dumbass fucking low, okay, I still got it was like almost a 4%. So at what point in the near future are we really going to see rates stupid low? I would argue that they're not going to be stupid low again in in the foreseeable future, at least in the next decade. Because if I was buying property at its height of rates being at the lowest and it was still 4%, even 4.5% on these properties, and I'm getting a 5.4 interest only, that's a good fucking deal. Yeah. So, what are we really talking about here? So see what I'm trying to say?
That's a good point. So at that 5-year mark, let's say, for example, that because it's interest only, the principal on the loan on the 5.4 would be approximately what? How much actual principal would be on that loan?
What do you mean?
If it's
what's the actual loan to value?
No, it's the loan.
The actual proceeds.
The loan balance, yeah.
On a 10-year, it'd be 3.5 million.
Okay, so call it 3.5 million, just for sake of the
it's like 3.48 is what
so
they would do.
So let's say that let's call it 3.5 million, and let's say that the value of the property in 5 years was $10 million.
Yeah,
how would that work for a buyer for them to? Because the original balance is 3.5 of the loan that they're going to be assuming, but you want $10 million. How do you make up the difference? Obviously, one option is that they just pay 6.5 million cash as a down payment, but would they take out a second mortgage?
No, they would assume the loan.
Right, but then how do you make up the difference of the 6.5 million of the purchase price?
Oh, they probably either have to step up the original balance or it'd be a second. Yeah. Yeah.
Is that what's common when people?
Yeah.
Yeah.
Yeah. I can't remember what they call it. They call it a catch up, or I can't remember what the fuck they call it over there, where the loan balance originally with the first lender increases.
Yeah,
because that's actually a good question. That's a good follow up question. Yeah. Let me ask Connor, who's putting the lender who's putting the deal together for me. Let me ask him if I go the 10-year and I wanna cash out after 5. What would that look like? That's actually a good question.
Because what I'm kind of thinking,
I'll call him right now.
Yeah,
call Connor.
Hey, Dan.
Hey, man. Yeah, we got disconnected. Yeah, no. Yeah, I'm here. So, got a question for you. Say I go with the 10-year with Fannie Mae on this loan. What would a say at the 5-year mark? I want to put the property up for sale, or even at the 3, doesn't even matter. And I want to go in. Is an assumable loan an option with these guys?
Yeah, they're fully assumable.
Okay, so they're fully assumable. Walk me through what would need to be done if there's any kind of nuances for an assumable situation like this, if at all any.
Yeah, so it's a 1% fee for the assumption, and that can be either priced into your sales price. You could have the buyer fund that, or you can pay it. So 1% to assume it, and then we would go in, reappraise the property for the new buyer.
Yeah.
Underwrite them, collect their financials. We already have all the financials on the property.
Yeah.
And then we would close. Takes about 45 days.
Okay, so it's actually it's quite a bit less intense than for the origination, obviously.
Yeah, because we, after that point, you're reporting on this quarterly.
Yeah.
And so we've got all the financials on the property.
Yeah.
It's been on our books. So
Yeah.
It's fairly easy. The only consideration would be, in 5 years, what your rates look like.
Yeah.
If they're higher, you're in a good spot. But if they're lower, it could, you might have to discount the property.
For sure.
To get someone to assume it. But
Yeah.
But if you've got, 5 years left and it's all interest only payments, that's still attractive.
Right.
Someone doesn't have to come in and do an amortizing loan.
Exactly. So, second question to that is obvious. So, say for example, the properties, call it $5 million right now. Say in 5 years, the property's worth 10, arguably, just for hypothetical speaking here. What does the new buyer do to close the gap?
So they could buy it, and then they can do a supplemental loan on top of it.
With the same with Fannie Mae as well.
Yeah.
Okay.
They wouldn't do a new loan on the first. They would just take that over from you, assume it, and then they can do a supplemental to bridge the gap.
Got it. Okay, and that's a fairly easy process over there.
Yep.
Okay. Awesome. All right, man. That's all I need to know.
Okay.
All right. Awesome. Thanks, buddy.
Okay.
Okay. Bye. Fuck. See what I mean?
Yeah.
It's actually kind of attractive.
That's interesting.
Right? Yeah. The fact that it's IO for 10 years.
Yeah.
And somebody would even find that attractive after 5 years, where they go in an extra the next 5 years. And if the rates drop, fuck, I should ask them. Hey, man. Hey, one last question I forgot to ask you. Do you find that banks are less likely to go IO or offer IO when rates are very low?
When rates are low,
Yeah. Like
banks
what?
in general aren't very good at IO. They may give you 1 or 2 years, but the advantage of Fannie and Freddie is that they can go, all the way up to full term.
Got
So
it.
even in normal circumstances, they're not great at it. So I would say, say you sell it in year 4, and you've got 6 years of IO payments left. There's probably very few lenders that would do a full term, 6 year IO deal. Yeah.
Got it. So this is
rare.
this is an attractive thing even for a buyer.
Yeah.
Yeah. Interesting. Okay.
Having the IO. Yeah.
Interesting. Okay. Awesome. Thanks, buddy.
Okay.
All right. Okay. Bye.
Cool.
There you go.
Yeah.
So there's that.
Because the way that I think about it is like if the, I don't know, we can finish on that.
I see this all the time.
Yeah.
I don't know that I've ever. It's very common to see properties in the U.S. where you have to assume the loan.
Mm-hmm.
It's very common.
1% is on the loan balance, so it'd be like $35K or so.
Yeah, so it'd be the same thing as like what I got to pay to originate it, right?
Hmm.
It'll be the same group, these guys or whoever, as lenders
'Cause
that would charge in origination.
That would be a lower fee than doing the 311, adding the fees to it.
You might as well just fucking go the 10-year and have a strategy at any point at within the 10-year. If the market is really hot, especially after 5, we're going to sell it.
Mm-hmm.
That's it.
Yeah.
We're going to pop it up for sale.
And especially if it's a hot market, you could probably even say that, listen, you as the buyer has been paying that fee.
100%.
Very interesting.
Yeah. Okay.